to your individual systems and how to pick those correct numbers. Is 1% a good number? Is 2% a good number? Is some other number a good number? Now let's start off with how we protect ourselves from ruining our accounts. If you've heard of risk of ruin calculations in the past, they're a simple mathematical technique, given that you're likely at some stage in your trading career to have a losing streak. You might have a streak of, well, a long losing streak that just wipes out your account. What we need to do is to have some sort of a view on how likely that is, given the quality of your systems and how much money we're throwing at it. And we typically do that by throwing a certain percentage of your account at a system, and we use, or most traders with these types of systems will probably use the fixed fractional method. For those who know the fixed fractional terminology, I'll just clarify what I mean by fixed fractional is where a fraction, a nominated fraction of your account is risked on each position. Some people use the terminology a bit differently, so as we get through the presentation it'll become more clear. Now let's just do a quick slide here. It just shows that if we've got a trading system that wins and loses 50% of the time, and this is a fairly typical trading system, there's a lot of good systems out there with a 50% win-loss ratio. You'd hope in the end that your wins are bigger than your losses, but in any case 50% of them are winners. So this is just a simple graphic which just shows that, for example, the chances of you having 6 losses in a row with such a system down there around about the 4 or 5% mark. So there is a chance you'll get 6 losses in a row. There's a chance you'll get 7 losses in a row. And that's just the law of randomness, the fact that your systems occasionally have random results. If they didn't have random results, if it was always one win followed by one loss, then you probably would have accounted for that in your system design itself. So having got the best system you can at system design phase, you'll start to end up with these losing streaks. Now that sounds fine in theory. That's an average loss streak for a system with 50% win-loss ratio. But randomness can still deal you another blow. We might have 100 traders sitting side by side running similar types of systems. Now there's 150 odd people, sorry, I shouldn't say odd, but 150 people on this webinar. So on this slide I'm just showing if 100 traders are sitting side by side running a system with those sorts of expectancies, 50% win ratio, then just by the law of luck, bad luck or good luck, one of those traders will probably have a loss streak of about 12 trades. One of them might be lucky enough to only have 3. So the markets are random. You have to protect yourself against those sorts of odds. Now if you were to risk 2% of your capital on a trade and you were to get a long string of losses like that, this little graph just simply shows that you'll lose 2% each time, you'll have a loss streak, and maybe at the end of 15 losses in a row, which is fairly extreme, but in any case, if you're risking 2% at a time, at the end of 15 losses you'll be down to something like a little over 70%, I think that graph shows. And by the same token, if we just step forward, if you're risking 5% at a time and you get that same situation, you'll be down to around under 50% of your capital. So you can see that getting those numbers right can make or break your account. Now I'll just define fixed fractional in a little more detail, because when we say that we're risking 2% on a trade, what we mean is that if we enter a trade and we get stopped out at our worst case anticipated stop loss, then we'll make sure that we lose 2% of our account. So essentially the graphic just shows that we enter, we lose, we get stopped out, so we've lost our 2% or 5% or 3% or whatever the number is. So that's just a graphic that shows how that works. For those who are interested in the calculation or want to program it themselves, there's the formula to do so. So your trading capital is 100,000, for example. We want to risk no more than 3%. knowing our entry price and where we're going to set our stop loss, you can work through the calculations, and that will work out in that particular scenario to 1,500 lots or stock shares or whatever your instrument is. But at this point, what we might do, given that hopefully we've covered the fixed fractional background and allocating a percentage to your capital, we'll start to move into something that gets a little more exciting, and that's how we calculate what that optimum percentage is for trading. And we do this. Some of you might have seen coin toss type games in the past, but we'll do it again. Coin tossing is obviously a 50% win-loss ratio over the long term. In this case, we'll have a system or a betting game where if it comes down tails, you lose $1. If it's heads, you win $2.
My Twitter updates, so, my blogs, podcast videos, they will all have a little icon, like a little...
And your winnings and your losses are magnified to the same extent. Now, expectancy is a Van Tharp term. Van Tharp was one of the references at the front of the presentation, and it's defined purely as the average expectancy that you can get per dollar of risk that you take in a system. So in this particular case, you've got a 50% chance of winning $2, you've got a 50% chance of losing $1. So you calculate that through, and your risk is, over time, you'll average a 50% profit per $1 that you risk. So the question comes down to, if we have a starting bank of $100, for example, what percentage of that bank would we take a risk on? Would we bet at each toss of the coin? I think intuitively we know that if we risk 2% of our bank as against 5% of our bank, then the potential profits at the end of a game will be quite different. And also, if we risk very high amounts, then we stand a much better chance of ruining the whole account, because obviously if we risk 100% and we lose on the first toss, we're out. We're finished as traders. Now, just at this point, some may have done a coin tossing game of this type in the past, but I'll just throw up a poll which I'll just put up on the screen for people to have a few guesses at perhaps what the optimum percentage is, which gives the gross best performance out of this coin tossing game. And I've thrown a poll up there which indicates if you throw 2% of your account at it, 5, 10, 25, 50, etc., as to which of those will give the maximum. Now, as I said before, there is an optimum figure, because if you risk a very low amount, you won't get much return at all. If you risk a very large amount, such as 100%, then you'll lose the lot at the first loss. And so there must be an optimum number somewhere in between. Most people have chosen 2 or 5%. So let's just throw up a spreadsheet which shows the calculations. Now, can everyone see a spreadsheet in front of you with about half a dozen columns? Am I getting any yeses? Okay, the spreadsheet's up there. I'll just explain it very quickly. Down the left-hand side, under the result column, we simply nominate that a -1 means we've lost $1 on this toss, a +2 means we've won $2 on this toss, or multiplied by the particular bet size that we take. Now, if we follow the calculations down the 2% column, for example, we take a loss on the first toss, so we've lost 2% of our $100 to start with. We're down to 98, then we go down to 96, etc. We get a couple of wins and it comes back up, it goes back down, it comes back up. And in the end, assuming, and this is a basic assumption, that we do exactly get our 50-50 win-loss ratio, which we would over the long term with a coin toss, but we'll assume for the sake of argument that we have 10 tosses and we get a 50-50 result, we end up with a 10%, 9.98% profit on our $100. If we throw 10%, for example, then our profit goes up to 46.93%. And I'll just unhide some extra columns here just to show what happens with various other levels.